Bill Ackman is a follower of Warren Buffett's investment philosophy and is known as one of the best investors in the world. He is the founder of Pershing Square, which is a hedge fund with over $18 billion in assets under management. Bill likes to concentrate the Pershing Square portfolio into a handful of bets, as he doesn't believe in diversification, but instead in investing in high-quality businesses with strong moats. Therefore, it's always interesting to see what Bill is buying and selling within his portfolio. And recently, he made a lot of interesting moves. So in today's video, I want to discuss the stocks that Bill Ackman is buying and selling, and why I think he is doing so. I also created stock analysis reports on all of the businesses we are going to discuss in today's video, with Stock Unlock's new AI tool. So if you would like to get the reports on Bill Ackman's holdings, then click the link in my description and you can download them for free. Now with that being said, let's hop into the video. So right here we can see Bill Ackman's portfolio as of the second quarter of 2024. And we can see that he reduced his position in Hilton, Chipotle, restaurant brands, Google, and Canadian Pacific. And the largest sells were Google and Chipotle. The other ones seem like they were kind of just trims in the overall positions. Now, what's also interesting is Bill Ackman purchased new positions in Brookfield Corporation, the ticker symbol BN, and Nike. Now, for those of you who have been watching my channel for quite some time, you know that Brookfield Corporation is the largest position in my portfolio. So obviously, I do like to see that Bill Ackman is buying Brookfield Corporation as well, because I do look up to him as an investor, and I do believe that he is one of the best investors in the world. Now, how the math works out is that Bill Ackman basically reduced his position in Chipotle Mexican Grill and Google to afford these purchases in Brookfield Corporation and Nike. So I personally think that Bill sold some of his Google and Chipotle Mexican Grill because he needed the cash to buy Brookfield and Nike. Because Bill does like to stay invested in the stock market. So when he finds a new stock, he does have to sell some of his existing positions if he wants to buy them. But then the question is, why did Bill Ackman choose to sell off Chipotle Mexican Grill and Google to afford these purchases? So let's take a look, and let's start with Chipotle Mexican Grill and go all the way back to when Bill Ackman first purchased it, which was in the third quarter of 2016. In December of 2015, Chipotle Mexican Grill had an outbreak, which caused 120 people to get sick after eating in their restaurants. Now, by the third quarter of 2016, when Bill first bought the stock, it had fallen roughly 50% and lost half of its value. In the company's third quarter earnings for 2016, it saw a 14.8% decline to its revenue, its comparable sales declined by 22%, its operating margin was cut in half, and net income declined by 95% as the business was hardly profitable. The stock also continued to fall after Bill Ackman purchased it, and it looks like Bill used this as an opportunity to buy more, as by the end of the fourth quarter of 2016, it was his second largest position at 18% of Pershing Square's portfolio. Fast forward 1 year to the third quarter of 2017, and Chipotle Mexican Grill saw its sales growing again, and its profits were coming back strong, growing 155% year over year, with 8% year over year revenue growth as well. This is a sign that the public tends to forget about these types of things very quickly, and the negative publicity, declining sales, and profits created an opportunity for Bill to buy Chipotle stock extremely cheap after the stock fell basically 50%. So now let's take a look at Chipotle Mexican Grill stock today. So back here in 2016 in the third quarter, it was about $7.90. The stock is now up roughly 575% over the past about 8 years, and it is currently trading for about $54 today. So the stock has performed incredibly well. However, if we take a look at Chipotle's price to free cash flow today, it is sitting at 55.8, which is a very high price to pay for any business. And this is a restaurant business, okay? So I do think that the price of Chipotle Mexican Grill is looking pretty dang high for what the business is. Now, don't get me wrong. I do think that Chipotle is a strong company and a high quality company. And in fact, we can see that its revenues are currently hitting all-time highs. And over the past decade, the revenues have compounded at 12% annually. However, I do think that a price to free cash flow of 55 for 12% annual revenue growth is insanely high. So if I were Bill Ackman and I was looking for a stock to sell to raise some funds to buy a new position, Chipotle Mexican Grill would definitely be number one on the chopping block, simply because of how expensive the stock is today. Bill Ackman initially purchased Chipotle Mexican Grill when the market was down on it, and it seemed like investors did not want to be involved with the company. Its revenues were declining, its net income was down 95%, And this kind of created a unique and short opportunity for him to buy the stock at a very cheap price. However, it seems like over the past 8 years, investors have now realized that this is a high quality business. And now it seems like every investor wants to own this business or is at least looking to get in. And that is reflected by its extremely high price of 55 times cash flows today. So I do completely understand why Bill Ackman sold off this position and used it to fund new positions in Brookfield and Nike. All right, but now let's move on to Google, which is the second major sale that Bill Ackman has had in his portfolio. Now, very quickly, I just want to say that I did make a full dedicated video to Bill Ackman's initial reasoning for entering Google stock. He went on the Lex Fridman podcast and he did basically a full in-depth thesis and explanation to why he purchased the stock. So I would definitely recommend watching out that video because it's going to go really in depth as to this whole investment and what made it so attractive to Bill. But what's interesting is Bill Ackman's initial investment in Google only took place in the first quarter of 2023, which means that he's now trimmed it down by roughly 25% in just 18 months. So it's kind of interesting to see him sell out of this one, or at least trim it down so much so quickly as well. So now let's talk about Google. Well, I don't know if a lot of you remember, but back at the end of 2022 and really at the beginning of 2023, Google and a lot of the tech companies were in massive corrections. Google was down 41% from its all-time highs that it set in back in 2021. And Google stock was down due to ChatGPT being launched, Google having a bad release of Bard, which made people think that Google was behind in AI, and everyone basically thinking that Google was going to lose market share to Microsoft and Bing. Basically, Google's moat was seemingly under attack, and the market believed that Google was actually going to fall behind and lose its profitability and overall market dominance in search. So once again, Bill was buying a stock that investors had a very negative sentiment towards, as the negative sentiment created cheap prices. In fact, in late 2022 and in early 2023, when Bill was buying Google, it was trading for its lowest price to free cash flow in more than a decade. And this is when Bill Ackman decided to buy Google. And even in the Lex Fridman podcast, he discussed how Google is always a stock that he wanted to own in a Pershing Square portfolio, but he really focuses on price when he buys investments, especially new investments. So he was waiting for Google to get down to a price that he thought it was very attractive and offering a margin of safety. And I do agree that back in 2022 and at the beginning of 2023, Google was an extremely cheap stock. And I was actually making videos on it here on my channel saying that Google was looking ridiculously cheap. And that's when I was also adding to my Google position quite significantly. But basically, Bill is someone who focuses heavily on the price of a new investment. And back at the beginning of 2023, Google was definitely selling for an attractive price. And you know what? We could go and take a look at Google's price to free cash flow. So back here in Q1 of 2023, it was sitting at about 18.9. And today, it is currently trading for about 32, even after the 20% correction that Google stock is currently in. And when Bill Ackman was selling Google in the second quarter of 2024, its price to free cash flow got all the way up to 33 to 34. So this is a massive multiple expansion that Google saw. In fact, if we take a look at Google's price to free cash flow at the beginning of 2023 versus today, we can see that the multiple has expanded by about 58%. That ultimately means that 58% of Google's share price returns since that bottom in early 2023 has come from multiple expansion and not from underlying fundamental growth. We can actually take a look at Google's free cash flow per share since this time, and we can see that it's actually grown by less than 1%. So in terms of what is driving Google's share price returns since the bottom in 2023, it has basically been entirely multiple expansion, or the market pricing Google stock higher and the market becoming more bullish and optimistic on the future of Google's business. It has not come from underlying fundamental growth or intrinsic value growth. So basically, if I were Bill Ackman looking for a stock to sell to raise some funds to buy some new positions, then Google would look like another clear choice because the stock did get quite expensive, especially in the second quarter of 2024, at least in my own opinion, especially when you take a look at where the share price returns actually came from. And you see that the entire share price returns came from multiple expansion and not really the business growing. So I do completely understand why Bill Ackman was trimming down his Google position, and we're going to have to see if he continues trimming it down in the future. All right, now let's move on to the two buys that Bill Ackman has had. And the first one is Brookfield Corporation. Now, as I said earlier on in the video, I talk about Brookfield a lot on my channel, because this is the largest position in my portfolio. And I initially started my position, I believe, back here around November of 2022. And then the stock continued to fall massively. And in this area right here, I was making videos on my channel about Brookfield saying how I believed it was incredibly undervalued. And since the bottom right here, the stock is now up roughly 73%. So I am up quite a bit on my position. And what's interesting to me is Bill Ackman is buying into Brookfield stock when it is trading right near all-time highs, which obviously suggests that he thinks that the stock is still cheap because he is someone who does focus heavily on price, and he thinks that the company has good management and will continue to grow over the long term. And of course, I do agree. So what I want to do in this video is kind of explain some of the key assets that Brookfield owns and a little bit more about what the business actually is. And then we can quickly explain the price of this business today and why I personally think it is also still cheap in the stock market, despite it selling for all-time highs today. So first off, what is Brookfield Corporation and what does this business actually do? Well, the easiest way that I have learned how to explain Brookfield's business is that they are a conglomerate, so they own a lot of different assets in different industries, but the overall theme around Brookfield Corporation is they own the assets that power the world and basically are the backbone of the world. Their assets are critical infrastructure that the global economy relies on and could not operate without. So in my opinion, that is like the best business you could possibly be in because the global economy literally would not work without a lot of Brookfield's assets, which means that they are going to be around for a very long period and continue producing cash flows and most likely growing over the long term as well. And I actually have some examples here from Brookfield's own website. So this says, providing critical water and sanitation services in Brazil. The business provides critical water and sanitation services through exclusive multi-decade contracts and serves more than 16 million people in over 100 cities. So you can see that Brookfield is providing clean water to over 16 million people in Brazil, and this business literally has multi-decade contracts. So this is going to be a profitable and cash-flowing business for decades to come. The next screenshot says, operating large-scale container terminals out of 4 key ports. This business is a leader in the industry, supported by significant contracts with large shipping lines, and is well positioned to benefit from Australia and New Zealand's future economic growth. So Brookfield owns some of the key ports in Australia. Basically, that means that if Australia wants to get its goods transported throughout the world, then it's going to have to use Brookfield's ports to get them there. And, that's a pretty good business to be in, and it's probably going to continue cash flowing for decades to come. All right, the next screenshot says, a leading independent communications infrastructure business. In 2015, Brookfield formed a consortium with its institutional partners to acquire 100% of TDF. Since the acquisition, Brookfield has successfully developed a build-to-suit tower program, completed the build of more than 1,000 new towers, and strengthened relationships with the major mobile network operators to position TDF as the 5G partner of choice. Today, the portfolio consists of 7,000 multi-purpose towers and active rooftop sites, and 5,000 kilometers of fiber backbone infrastructure. So this asset that Brookfield owns is literally connecting the world. And with our world becoming more interconnected and relying on the internet more and more every single day, I think that this is another great business to be in that is also going to cash flow for decades to come. Now, one asset that Brookfield owns that I am super bullish on is Westinghouse. Westinghouse is the leader within the nuclear industry, and they have some of the most advanced nuclear reactors in the world. They're currently working on SMRs, which are essentially small reactors that can be deployed in cities or even just in local communities to power those communities. And through this new SMR technology, which Westinghouse is currently a leader in, I do believe that we are actually going to be able to achieve our net zero carbon emission goals within the next few decades. Basically, SMRs are going to provide the clean base load that our economy needs. And I have a few articles here that I want to share with you all about Westinghouse. So this says, Westinghouse unveils game-changing AP300 small modular reactor for mid-sized nuclear technology. The Westinghouse pioneered advanced passive safety system automatically achieves safe shutdown without operator action. The AP300 is designed to operate for an 80-plus year life cycle. The AP300 SMR design utilizes Westinghouse's proven Gen 3 Plus advanced technology, which has regulatory approvals in the US, Great Britain, and China, as well as compliance within European utility requirements. Standards for nuclear power plants. Design certification is anticipated by 2027, followed by site-specific licensing and construction on the first unit toward the end of the decade. The AP300 is the only small modular reactor offering available that is based on deployed, operating, and advanced reactor technology. So quite literally, the AP300 is the only small reactor that is actually based on technology that is currently being used today. So this is one of the reasons why I think that the AP300 SMR is going to be approved for actual use by the end of the decade. And this is a really long-term thing right here. But I do truly believe that nuclear is going to become a massive industry in my lifetime. And I think that a lot of investors are currently sleeping on the nuclear industry. And Westinghouse, which again is owned by Brookfield, is one of the leaders that is pushing this technology forward and actually working with these governments to get these SMRs in place and built out by the end of this decade. So I do think that these small reactors are going to be in development and being built by the end of this decade. And I think that this could be a game-changing technology for clean energy, for the world, and for overall our energy consumption and generation. So I think that this is going to be a huge aspect to Brookfield's business over the extremely long term. And I love Brookfield because they do play the long game. And they acquired Westinghouse back in 2017, and they have been working with this business to continue developing this technology that the world is definitely going to need. And they're just playing the extremely long game, and that's what Brookfield does. All right, so now let's talk about Brookfield's valuation today. So the company is currently trading for a market capitalization of about $71 billion in the stock market today. Now, on an annualized basis, Brookfield is actually doing about $5.5 billion in distributable earnings, which is basically the company's own calculation for free cash flow. So if we go $71 billion in market cap divided by $5.5 billion in distributable earnings, once again, basically free cash flow, then it suggests that the business is trading for about 12.9 times cash flows today. Additionally, Brookfield is projecting its distributable earnings to grow by 22% annually all the way out to 2028. Now, if we include the gains on their investments and we factor that into the actual cash that the business is projecting to generate, then they are expecting to grow distributable earnings by 25% annually all the way out to 2028. So when I take a look at Brookfield, what I am seeing is a business trading for around 13 times cash flows and projecting 22 to 25% annual free cash flow growth over the next 5 years. And that low of a price ratio for that much growth is something that I do not see in the stock market too often. And then additionally, Brookfield has an incredible management team that is led by Bruce Flatt. It is a very shareholder-focused business that is entirely focused on creating and protecting shareholder value, and I think that it has a very long runway ahead of it with Westinghouse and with all of their other assets that we discussed in this video. So I think that Brookfield personally is a freaking slam dunk of an investment. It basically checks all the boxes on what I look for in an investment, and that is why it is the largest position within my own portfolio, and those are all the reasons why I think that Bill Ackman would potentially be interested in the stock as well. All right, now the last stock that we got to talk about is Nike. Now, I got to be honest, this one kind of shocks me because Nike, I made a full video on Nike not too long ago, and this most recent earnings report that they put out, and I don't actually think that Nike is looking like a super attractive business in the stock market, and I don't think that the stock is actually cheap for what the business is today. So let's start from the top by taking a look at how much Nike is down from its all-time highs, and it's down about 53%. So what Bill Ackman could be doing is looking at how much the stock is down and thinking that it may be looking interesting. I'm sure that he also believes that Nike is a globally renowned brand and probably will recover over the long term. However, if we take a look at Nike's revenue, we can see that it is currently topping out and it's actually starting to come down as of the most recent quarters. We can also see that historically, when there is a recession or some sort of stock market bubble pop, it looks like Nike does have a weakness in sales. For example, right before the tech bubble, we can see that Nike's sales did drop. And then again, during the Great Recession, we can see that Nike's sales did drop once again. However, its revenue does seem like it does trend upward over time, but right now it does seem like the revenue is going through a little bit of a harder period. If we take a look at the company's operating income, we can also see that it is down from its all-time highs, and the overall profitability of the business has been coming down as well. Now, in the most recent quarter, Nike also said they now expect fiscal 2025 reported revenue to be down mid-single digits, with the first half down high single digits. So the company is continuing to expect its revenue to decline for the remainder of the fiscal year 2025. So the company is definitely going through a little bit of a challenging period right now. They also said that they expect their first quarter revenue to be down approximately 10% year over year. So just like how when Bill Ackman initially purchased his Chipotle position and the company's revenue was going through a decline, it looks like Nike's revenue is going through a decline as well. However, Nike is still selling for a price to free cash flow of about 18.4, while projecting its revenue to decline by 10% in the next quarter, and it is projecting its revenue to decline in 2025 as well. So this price ratio of 18 for revenue decline, I think is actually still a pretty high multiple to pay. And I do think that this multiple is still factoring in some growth to Nike's overall business. So to me personally, I do not think that Nike stock is looking quite attractive yet, and I don't actually know where I would be buying it, or if this is ever a stock that I would want to be buying, because I think that the fashion industry is incredibly hard to predict. And if you told me that Nike was going to be losing market share to smaller companies like Lululemon, I would have not really believed you. But this is just kind of how the fashion industry works. Brands come in and out of fashion, and I don't know how to predict which brands are going to be big or popular in the next 5 years or in the next 10 years. And for that reason, I have largely stayed out of the fashion industry. In fact, I have stayed entirely out of the fashion industry, and I do plan on continuing to do so. So this is the one purchase on Bill Ackman that I don't necessarily agree with, ultimately because I think that Nike is losing market share. Its sales are currently declining, but I don't think that the price is reflecting the sales declining today. So I don't think that it's really selling for a super margin of safety, at least in my own opinion. And I think that, I would want this stock a lot cheaper if I were actually looking to take a position in it. And with all that being said, that is going to wrap up the video for today, everyone. And those are the major moves that Bill Ackman is making within his portfolio. So let me know what you all think down in the comment section below. And if you did enjoy this video, then please remember to leave a like on it. And if you want to stick around and see more stock market related content like this, then consider subscribing to my channel as well. Also, do not forget to get those free AI stock analysis reports in the description. Those are very in-depth reports that will explain a lot more about these businesses, their prices today, the management teams, etc., and they're completely free. So click the link in my description and go and get those reports. But with all that being said, thank you all so much again for watching today's video. I truly do appreciate it, and I really hope to see you all again in my next one.